So this is where call credit spreads can really be helpful. Now, these are what we call a negative risk ratio trade or probability trades, okay? So here's just a good example to kind of illustrate the risk reward ratio of these. So here's like if you're short this short strike right here. So you're short a call right there. That's the 120 strike right here, okay? And then that we're going to say has a delta of 20, okay, plus delta of 20. All right, so then to hedge it, so in order to not be naked short, so if the market goes straight up, you've got a lot of risk, we're going to buy a call above it, and this would be the 1030 strike. So we've got the 1020 to 1030, and that's your credit spread. Now you can see the spread width between that is $10, which is, you know, $10 is 1,000. So remember, one option contract's equivalent to 100 shares. So this would be a spread width of $1,000 wide. Now with this example, this brought in a credit of $200 right there. All right, so you've got $1,000 wide spread. You brought in a premium of $200. So that's your income or your profit if you want to look at it that way. But look at your risk. Your risk is the difference between the $1,000 wide spread, the premium you brought in. So your risk is 800. So that's your margin you would have to put up. And if you look at this, this would be, you know, if you keep that full $200 at expiration, that's a 25% return. So that's about what you get, 25, 30% returns, you know, on these credit spread type trade setups. Now, this is also then a negative risk ratio. So in this example, you're actually risking $4 to make $1. So you're risking $800 to make 200, okay? So that's what it looks like, but it's a probability trade because if you sold the 20 delta, theoretically, you've got an 80% probability, right? Based on the options, the delta, you've got that 80% probability that price will be below that short strike of 1020 at expiration, or there's only a 20% probability or chance that the price will be in the money at expiration, okay? So that's what we call a probability trade. So you've got an 80% probability. So that's why you've got a negative risk ratio, because you're theoretically, there's a high probability that the price will be below that short strike.